Learning about risks isn't my idea of a fun time, so to add a little levity, I'm going to start this lesson with a story that pokes a little fun at myself. When I first got my driver's license, I was only 16 and I was working part-time at Kentucky Fried Chicken. I didn't have enough money to buy a car, so I always had to borrow my dad's minivan to get to and from work. The cost? I just had to bring home a couple pieces of chicken after my shift. Now, before I left the house, he would always say something like, "It's snowing outside, son," which it always was because I grew up in Northern Ontario, "so make sure to leave yourself enough room to stop." And I'd roll my eyes and say, "Okay, Pops, see you later." Well, I thought I understood the risk, but I didn't really get it until I found myself skidding down the main street one night feeling completely helpless. In other words, I had to actually experience the consequences for myself before I truly understood the risk. So, to help you experience and better understand the risks applicable to a debt security like a bond, let's pretend you bought a bond and discuss how these risks could impact you. Now, wherever possible, we tend to use very simple examples, but in this case, we're going to use a bond with some extra features, which makes it susceptible to a whole bunch of risks. Alright, let's take a look at your bond's features. It's a newly issued corporate bond with a 10-year term. The issuer is ACO, a Canadian company, but the bond is denominated in US dollars. It has a fixed coupon rate of 5%. You bought $100,000 face value of the bond at par and were quoted a yield to maturity of 5%. The bond has a callable feature and is callable on the 5th, 7th, and 9th anniversary dates at a call price of $102. While you thought you understood the risks associated with a fixed coupon bond, those risks became more real for you one evening in a bad dream, where the bond monster hit you with all of the possible bond nightmares you could face. Risk number 1, default risk. What if ACO, the issuer, experiences financial difficulty and can't afford to pay its employees' salary, never mind interest payments on its debts? You could lose your money. Risk number 2, interest rate risk. What if interest rates increase and newer bonds with similar remaining terms are being issued with a 10% coupon rate, which is much higher than your 5% bond? The market value of your bond would plummet. Risk number 3, reinvestment risk. What if when you receive interest payments, you can't reinvest them at a rate of 5%? Your actual YTM would be less than the quoted 5% yield to maturity. Risk number 4, timing risk, also known as call risk. What if on the first call date your bond is trading at a premium of, say, 107? It's the issuer's option to call the bond at a price of 102, so do you think they will? Yeah, of course they will. You'll receive 102 for a bond that's really worth 107. Risk number 5, inflation risk. What if the inflation rate is incredibly high, like 7%? Your 5% coupon rate wouldn't even be keeping pace with inflation, which means you'd actually have a negative real return each year. Even a realistic inflation rate of 2% would lower your approximate real return to only 3%. Risk number 6, exchange rate risk. What if the Canadian US dollar exchange rate changes a lot? Every time you exchange your US dollars into Canadian dollars, you never know how much you're going to get. You could get less year after year. Risk number 7, marketable risk. What if you need your money sooner? Well, you can sell the bond, but market conditions may not be good. There are no guarantees. In order to sell your bond, you may have to accept a price that's lower than the bond's intrinsic value. Risk number 8, political or legal risk. For example, even if you manage to sell the bond for more than what you paid, right now only half a capital gain is taxed, but that can change with new legislation. Risk number 9, event risk. What if global warming causes extensive damage to the Canadian environment, crippling the economy, including ACO, which eventually defaults on its bond payments? Risk number 10, volatility risk. What if market conditions work against you? For example, if interest rates increase, bond prices will fall. A bond with features like callable or convertible will be even more volatile in price, which means they'll fall even more. Risk number 11, sector risk. What if the entire sector ACO operates in has a bad quarter? ACO will likely do poorly as well, even if it's a well-managed company. And finally, risk number 12, yield curve risk. What if the yield curve moves against you? Yield curves will be discussed in more detail in another mini lesson. Remember, this was just a bad dream, so the bond monster was scaring you with all of the possible nightmare scenarios. But keep in mind that many of these risks can have positive consequences too. For example, with interest rate risk, increasing interest rates can put negative pressure on the market value of existing bonds. But falling interest rates will actually push existing bond prices higher.